Welcome to the Strategy of the Week presentation for 11 October 2013. My name is Todd Shaffer. I'm the Manager of Research for VectorVest, and I'll be providing a strategy presentation this evening. This week's strategy is titled Kevin's Keepers, because it's rooted in our presentation from last week, which was presented by Mr. Kevin Crowe. That presentation was titled A Prudent Pathway to Consistent Profits. He began with a quote from our founder, Dr. Bart DeLito. Your job as an investor is to preserve and increase your net worth. Kevin then related that all too often clients take unnecessary risk with their investment strategies in the pursuit of making big gains. And that got me thinking of the many tools within the VectorVest system and the methodologies that Dr. DeLito has advocated over the years on how to manage or minimize risk. And so tonight we'll begin with a quick review of Kevin's demonstration of a prudent stock selection approach combined with market timing to minimize the risk that comes with holding through bear markets. This week we'll travel even further down that pathway toward consistent profits, incorporating more of those VectorVest tools in Dr. DeLito's guidance. So our objectives today, we're going to automate Kevin's selection criteria in a new search called Kevin's Keepers. We'll optimize our performance in the backtester, maximizing our gain and minimizing our risk. And finally, review Dr. DeLito's previous guidance on how to further minimize risk as we implement our trading plans. We'll begin with a quick review of Kevin's stock selection criteria and market timing. Kevin showed us a very easy to execute methodology that begins with the stock viewer, with the top VST stocks. From that list, he cherry-picked stocks that met specific criteria. Those criteria had to be that RV was greater than or equal to 1, relative safety was greater than or equal to 1. The recommendation equals a buy. Earnings growth was greater than or equal to 20%, and comfort index was equal to or greater than 1. And for his demonstration, he bought those on confirmed up calls, sold them on confirmed down calls, and ran a test bed of dates from the 19th of December 2012 to the 30th of September 2013. He then demonstrated an easy methodology of going to the stock viewer, looking at the top VST stocks, and simply cherry-picking from the list the stocks that met all of those criteria. So my first step and our first objective tonight is to automate the search process using our UniSearch tool. Let's move into the program. From our home page, we'll come to the tabs above and click on UniSearch. The thing I love about the UniSearch tool is that it's so easy to use, and it's written in plain English, and it's very linear. Any parameters that I specify in the parameter window here is additive, meaning any shares that are returned by the search need to meet all of the criteria listed. To enter the criteria, it's a simple matter of point and click, and it's helpful to be familiar with the layout of the stock viewer because the criteria will come in that same organizational pattern. If you're a new user, I'll often suggest that you print a stock analysis report so that you can get that layout. But I simply left-click in the open parameter cell, and I'm going to choose our first criteria. I want to look for stocks whose RV, which is in the capital appreciation section, and then select operator is greater than or equal to a custom value, and I type 1. Our second criteria was that relative safety was also greater than or equal to 1. And you see that once you get the hang of this, it's relatively simple. Next, that the recommendation was a buy. Next, the earnings growth rate was greater than or equal to 20. And comfort index was greater than or equal to 1. Now, in addition to Kevin's criteria, because he was cherry picking, I'm also going to add minimum price and volume requirements. That we have a price actual greater than $1, and that we have a minimum average volume, and of course you can customize these any way you like. Average volume greater than 25,000 shares. And we're going to sort all of the shares in the database that meet these criteria, all of those criteria, We're going to sort them VST descending. And to make it easier for you to replicate our results, we've added this search now to the Searches Prudent group. So Kevin laid the foundation for achieving consistent returns and minimizing risk with this prudent search combined with our market exit on the confirmed call signal. Our next objective is to further define and manage that risk reward with money management rules. For this, we need the backtester. And so I go to the top tabs again and click on backtester. In the interest of saving time, I've already run all of my backtests, but I began the process by creating a base run with no money management at all other than the timing signal and the number of stocks to hold. This essentially trades the search on the timing signal alone. This lets me assess the raw performance of the search and start to define the risk-reward profile. If I click on it, we can see its equity curve. We had a 23.83% gain, which averaged 29.41% annually, with a maximum drawdown of 6.36%. If we look at the equity curve below, we see both runs went a little underwater at the beginning of the run, but both runs finished higher than they started. Not a lot of volatility. It looks like that biggest pullback was here in the first run in February. For my next step, I then struck copies of this base run and used multiple stop combinations to try to discover the optimal combination in this time frame. Here are my test results. I've sorted them annualized rate of return descending. In the name, you can see the stop combination that I was using, and we can see that 3 of the combinations outperformed that base run in terms of overall gain. But to Kevin's point, it's not all just about gain. How much risk are we taking on? How much risk are we assuming by taking on this trading plan? Well, broadly, the first thing I see generally is that the stops that performed best in this trading plan were the looser stops that let my winners run. Conversely, the worst performing backtests were those that had tight stops. And this is consistent with nice trending market periods such as the one we're examining here. Of course you can, and I would suggest you do, test other time frames as well. As we look more closely at these results, I want to examine that relationship of reward to risk. Risk in this case defined as the maximum drawdown or the largest single pullback in the portfolio value over the test period, a rather conservative approach. Here I see the top performers all improved gains over the base run and had lower drawdowns. I see my top performer had an annualized rate of return of 32.79% with a drawdown of 5.5%. That's with a stop-loss combination of a 50% gain and a 20% loss. My third performer, with a gain of 50% and a loss of 10%, gained 31.79%, 1% less, but had about a 1.5 less maximum drawdown. So on balance, I prefer the lower drawdown of the 50-10 combo because I didn't give up much gain overall to get it. Although I did have a little bit more trading activity. Now, just so you can replicate these results in your own program, let's quickly review the settings that we had for this backtest. I'm going to click the Edit button. First, we had an initial investment of $25,000. We had a commission load of $20 per trade. We did not use margin. Next, we used the confirmed calls. To automate this market timing signal, you do have to have the auto tester. That is an additional plugin module that lets you automate entry and exit on your trading plan. You can, however, replicate these results just by running point to point. For the confirmed up situation, we used Kevin's Keepers, the search we had with a 50% gain and a 10% loss. In our more settings, we used 10 positions, automatically replacing those 10 positions. We opened all 10 immediately. When we entered the confirmed up call, we closed any open positions. We invested our average portfolio value into each position. We bought odd lots. We limited purchases of stocks that we currently own. And we limited our maximum percent of the stock's average volume to 2%. On the confirmed down call, we went to cash. And our test period went from the 19th of December 2012 to current. Of course, we did have a confirmed down call on the 7th, and so we've been in cash for those past 4 days. And you should have a test result that returns a 25.76% gain with a drawdown of 3.92%. If we look at the equity curve, we can see that we did impact that drawdown by having that stop to minimize the losses on that one pullback. And again, we still maintain that low volatility equity curve where both turns got to higher highs. And that's not to say that you'll never suffer losses. And of course, some market periods are more difficult than others. But we're well down that pathway to achieving consistent returns, meaning we win more than we lose, and our winners outpace our losers, which over time delivers portfolio success. This brings us now to our third objective. How can we further manage risk as we implement this trading plan? How I enter my trades impacts how I sell and what kind of risk exposure I assume. Well, Dr. DeLito has written extensively about managing risk. And if we go back to our slides, here is a partial list of some of those important essays for your study. I've captured some of the key concepts from these essays on the next slide. I realize this will be a quick overview, and so I refer you back to those essays for more details, but the first overriding principle is the 1% rule. We never want to risk more than 1% of our portfolio value in any trade. This is not a 1% stop loss. This means that if you had, for instance, a $100,000 portfolio, the most you would be willing to lose in any particular trade would be $1,000. A $50,000 portfolio, the most you'd be willing to lose would be $500. This supports the first rule of investing: preserve your capital. And the idea is this: once you've applied your stop, if you're not risking more than that 1%, you can make several mistakes or several bad trades, suffer several losses, and still live to trade again. The second step is to evenly dollar weight your portfolio. In your portfolio, you should diversify over several positions, typically 5 to 20, depending on your temperament. Each of those positions should be relatively the same dollar size, not the same number of shares. We want to spread the money evenly in those positions across the portfolio. As an example, again using that $100,000 account, if I had 10 positions, then each position would be roughly worth $10,000. A $50,000 portfolio of 10 positions would be $5,000 each. If your portfolio is still small because you're just starting out and you can't afford to fund 5 positions, then we suggest you do something like an ETF or other fund so you get the benefits of diversification within the fund. And you can still manage those funds with our market timing system. Combining Rule 1 with Rule 2 then, once you've applied your stop loss to your portfolio position size, you want to make sure that it never exceeds the 1% rule. Dr. DeLito does give us the formula for this equation in his essay, but to keep the math simple, a fully invested portfolio will reach a 1% exposure if the number of positions matches the stop loss. In other words, a 10 position portfolio can have a maximum 10% stop loss. A 5 position portfolio can have a maximum 5% stop loss. A 20 position portfolio can have a maximum 20% stop loss per position. Well, what do we do if we have a 10 stock portfolio but we want to trade a 20% stop loss? Well, we need to adjust our position size then by cutting it in half so that when we apply the broader stop loss, we get to the same 1% rule. And this is why it's so important to define your exit before you even take the position. Our third step, keep commissions low. In fact, ideally less than 1% of the trade. It's not uncommon for a small portfolio that's actively traded to actually lose money because of the commission load. Our next step is confirm the market follow-through before you take your positions. Right up till the time you're going to place that order, you want to make sure that the market is continuing to trend in your direction and the stocks you're about to trade are continuing to trend as well. You'll often hear us refer to amateur hour, where we wait for that first half hour or hour in the early market for the overnight orders to clear so we can discern direction of the market trend for the day. Next, we want to step in to build your portfolio to minimize risk by spreading your risk over time, as opposed to jumping in with all 10 stocks, for instance, all at the same time. This is particularly helpful in the case of a whipsaw signal or if you're buying into a mature trend. Next, Dr. DeLito has advised that we never give back more than 1/2 of our gain. Of course, you have to be reasonable here, where you have to build up some gain before you want to employ this idea. But once you're up 10% or so, then you don't want to give back more than half of that. Nothing is more disheartening or painful than to watch a winner turn into a loser. And finally, cash is a position. There's nothing wrong with sitting out a volatile or a falling market condition. In fact, we don't think it makes sense to try to hold through the downtrends just so you have to gain back your losses. And for that reason, we advocate going to cash in downtrended markets, or at least hedge the positions that you want to hold on to. Well, I hope you find these pointers helpful and appreciate how the VectorVest service offers us the tools and the information that we need to improve our odds and to manage that risk. With that, I'll conclude our presentation for this evening. I thank you for being with us. Of course, if you have any questions about this presentation, please give us a call or an email in product support, and visit the VectorVest University for our previous presentations. And until next time, have a great week.